Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Good morning. Happy Monday. It is the 21st, 2022 of November. The leading economic indicators, I don't know if you guys follow Lizanne Saunders from Charles Schwab. She's definitely a good follow on Twitter. She puts out a lot of graphical data quite often, and this morning she put out leading economic indicators for October coming in at minus 2.7%, worse than the average start of a recession at minus 2.2%. And you've got Goldman Sachs out there joining Morgan Stanley's Mike Wilson, calling for more downside going into 2023, believing recession's likely, looking at forward earnings and seeing vulnerability there. We've talked about that ourselves. They're looking at, I think Mike Wilson is saying he sees 15 to 20% downside risk for earnings in 23. The one thing, as you look around at all the moving parts that can prevent a recession, is the strength of the consumer, who, thanks to wage inflation, is making more than they have and probably ever when it comes to middle-class jobs, things of those nature. The services side of our economy is still really strong, travel, restaurants, what have you. But that's all an area where inflation looks to be really sticky as well. So it's a tough deal out there right now. Housing, I think, is going to call the shots in terms of what happens with the consumer. If we can prevent a real downdraft in pricing, that'd be a huge positive, obviously. The problem is you've got tons of completed new homes coming online this quarter. I think a lot of the supply chain bottlenecks, what have you, loosened up, and builders kept building in line with the demand they were seeing. Obviously, that demand has totally gone away overnight. But once those homes are done, you're going to have some of the smaller builders that are going to need to make sales. They can't just sit there forever and risk insolvency. They've got a income statement and a balance sheet to balance. So that's going to be a big risk. We'll see what starts to happen there as we get into 23. My two cents on the Disney move, Bob Iger coming back, I think is definitely a positive. The guy's a total stud. It's probably worth 10% of the stock, which is where it's trading. So I'm not sure if you're uninvolved, it might make sense to just, buy a little bit and see what happens. I think Bob Iger's going to get the benefit of the doubt, whereas Bob Chapek got, more skepticism when it came to his decisions. Another thing that's interesting, cold weather in the U.S. Yesterday, the average temperature in the U.S., I think, was below 30. That was like the earliest time it's happened in the calendar year, I think, in quite a long time. There's a huge mass of cold air over the North Pole, like negative 80 degrees Celsius type stuff. I'm not a meteorologist, obviously, but I've seen a couple of them on Twitter talking about a very cold winter for this year. And you see that, and obviously, the natural gas up over 2% this morning. We added to a couple of our E&P names last week on the downdraft that's happened there. It just seems like, I don't know, it just seems like maybe people are writing off nat gas a little too quick. This thing can definitely come back. Small cap natural gas E&P companies are trading at around 2 to 4 times EBITDA. That seems like a pretty significant inefficiency in my book. So that would be my kind of shopping list. The attractive assets, 3 times EBITDA. It looks like a no-brainer right here. Have an awesome Monday.
disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.